Good evening, everyone, and welcome. When the Federal Reserve speaks, Wall Street listens, and today's release of minutes from the Federal Reserve's latest policy meeting, along with an encouraging start to earnings season when Alcoa reported profits yesterday, well, they combine to help send stocks higher for the first time in 3 sessions. The nation's central bankers seem to agree on when to wrap up their latest bond-buying stimulus plans, but they differed on when to raise short-term interest rates. Despite that, investors liked pretty much what they heard. The Dow closed near the highs of the session, up by 79 points. The Nasdaq up 27, and the S&P added 9. Steve Leisman has more on those minutes from the Federal Reserve's latest policy meeting and what the central bankers are thinking about how and when they'll announce the very first rate hike since June of 2006.
The Federal Reserve providing details of how it will eventually bring to an end the great monetary policy experiment launched in the wake of the financial crisis. Minutes of its June meeting show the Fed planning to end QE by October if the economy improves as expected. The Fed will hold on to the $4 trillion of bonds it purchased on its balance sheet through QE at least until rate hikes begin. At that point, the Fed could let the balance sheet wind down to more normal levels, but do so very gradually. The Fed said very little new about when it will hike interest rates or by how much. That leaves intact the general market expectation for gradual and modest rate hikes next year. The market liked what it heard, particularly about the Fed's gradual approach to tightening policy over time. There is disagreement on the central bank. Some on the Fed believe the job market is tight already, risking inflation sooner than expected. Economist Bob Bruska says there's danger the Fed could make a mistake acting either way, too fast or too slow.
If you do it at the wrong speed, you could make any of those mistakes. And right now, we don't really know because we had a terrible first quarter GDP number. It looks like we're digging out. Some of the employment numbers are starting to look better. But, you know, we've created like 1 million jobs over 5 months, several other times in this economic recovery. So you can't put this increased job growth in the bag yet.
Indeed, the Fed said it was surprised by the sharp decline in first quarter growth, but continues to expect a second half rebound. The speed of that rebound and the potential for it to create inflation could determine how fast and how far the Fed raises rates next year. But that's a problem Fed Chair Janet Yellen will confront when she has to. The minutes of the June meeting show the Fed making plans to bring the great monetary policy experiment to an end, but in no particular hurry just yet to shut down the laboratory. For Nightly Business Report, I'm Steve Leisman.
Let's turn now to Mohamed El-Erian for his take on all of this. He's Chief Economic Advisor at Allianz. Mohamed, great to have you back on the program. You know, everybody's fixated by rising interest rates, and we know at some point they're going to go up. Is that such a terrible thing for the economy and the markets, or could it actually be a good thing?
It could be a good thing if it comes as part of economic growth and job creation. And let me explain. Right now, everybody is hoping for economic liftoff. And economic liftoff would be not just good for Main Street, it actually would be good for Wall Street because it would validate asset prices. Once that happens, the Fed will start to move. So the expectation is the Fed will probably start hiking towards the middle of next year, but it will be a very gradual hike and it will stop below the levels that have prevailed historically.
So, Mohamed, what if economic liftoff doesn't happen and you've got asset prices, as the New York Times pointed out in a front page story yesterday, elevated in many, many categories, from equities to farmland to commodities and so forth? What happens if there is no economic liftoff?
That's the big risk, right? The Fed has the following trade-off. We're willing, the Fed says, to underwrite future financial instability as long as we get economic liftoff. If that economic liftoff doesn't happen, then not only do we have a sluggish economy, but we also have a high risk of financial instability. Put another way, instead of the fundamentals validating the prices will have to come down. And that's one of the big risks. The other risks is that they overdo it and we get inflation in the system, wage inflation in the system. So that's why it's a very delicate balance, and it's one that we haven't seen this delicate for a very long time.
You know, Mohamed, one thing that popped out from those minutes in terms of what I saw was this quote that the Fed was saying that investors are not factoring in sufficient uncertainty about the path of the economy. What's your interpretation of what that means, and what's the problem with that?
So they're worried that the markets are too complacent. They look at how low volatility is. They look at certain element of risk taking. They look at certain bubblish markets, and they're worried. They're worried that the markets are too complacent. Now, they know why. Mrs. Yellen told us last week in her speech to the IMF, which is very low interest rates encourages excessive risk taking. So they're worried. They're hoping that they can signal the market, nudge the market into being a little bit less complacent. But they're worried. But you know what? That's part of the game right now, which is in order to stimulate economic growth, they have to come through the asset markets.
How worried are you, Mohammed? How worried specifically are you that the eventuality that you just described, i.e. that there will not be economic liftoff, might come to pass? And in that case, asset prices will come back down. How worried are you? Handicap it for us.
So I'm worried for two reasons. The first one is that we really need productivity growth. We could end up in a situation where not only growth doesn't come back fast enough to lift off, and liftoff is the important concept, but we start getting wage inflation because it turns out that quite a bit of unemployment is structural. So that's the first element. We need productivity growth. The second element is we need what are called macroprudential policies, which is a fancy name for saying the ability to control risk. We need them to work. And those two things historically have been very difficult to predict. So I am worried. I think that there is much more risk in the markets than people are reflecting right now.
So a lot of people listening to you right now, especially individual investors, might say, ooh, it's risky, this is a scary time. And even though we hear all of these milestones, maybe I shouldn't put my money in the markets. Is that what you're saying?
No, I'm saying put your money in names that you understand well and not in the market as a whole. So look for names that are resilient, that have a disruptive technology or something that captured market share, and that still have scope for cost reduction. This is becoming more and more a name-picking, a stock-picking market than a general beta play, as the technicians would say.
All right, Mohammed, always great to have you on the program. Thank you so much for joining us. Mohammed El-Erian with Allianz.